Hello and welcome to another episode of Malone Bailey's official podcast, Everybody Counts. Thanks for tuning in. I'm Carolina from the recruiting department at Malone Bailey. Hopefully this isn't your first time tuning in, but if it is, welcome. Our podcast, Everybody Counts, features various perspectives on a variety of topics, from the latest SEC and FASB updates to discussions on recruiting, retention, and more. Everybody Counts explores trends and hot topics that affect us and those in our business. Tune in to hear from partners and staff alike. The conversation is versatile and everybody's input counts. The focus of today's conversation is on a few FASB accounting standards that will go into effect in the 2025 calendar year end. I'm delighted to be joined today by Mariano Frigon, partner at Malone Bailey, who will share his thoughts on these accounting standard updates, otherwise known as ASUs. Welcome, Mariano.
Thanks for having me, Carolina.
Absolutely, Mariano. So before we dive into today's topic, can you share a little bit with us about your background and what you do here at Malone Bailey?
Sure. I mean, just to give a little bit of background, I'm originally from Argentina, where I actually graduated with a degree in accounting as well as a degree in business administration. Right out of college, I started my public accounting career at PwC Argentina. And in 2015, I actually moved into the US, where I spent my last 2 years doing a tour international office. Right after my tour finished back in 2014, I actually joined Malone Bailey as a partner. In Malone Bailey, I'm currently responsible for providing technical accounting and auditing consultation support. I'm also a QC partner, and I'm also serving clients. So that's a little bit of background about myself.
Thanks so much for sharing that with us today, Mariano. Thanks so much for sharing that with us, Mariano. Today's conversation is going to be an interesting one. On this episode, we'll share a brief overview of a couple of the FASB accounting standards, again, otherwise known as ASUs, that go into effect in the 2025 calendar year end. While there are many in this episode, we'll touch on the following ASUs and dive deeper into each of these in upcoming episodes of our podcast, Everybody Counts. First one we're going to dive into is going to be the ASU 2023-05 titled Business Combinations Joint Venture Formations, subtopic 805-60, Recognition and Initial Measurement. We'll also touch on ASU 2024-01 titled Compensation Stock Compensation, topic 718, Scope Application of Profits, Interest, and Similar Awards. And lastly, we'll touch on ASU 2025-02, titled Liabilities 405, Amendments to SEC Paragraphs pursuant to SEC Staff Accounting Bulletin number 122. Additionally, ASU 2023-08, titled Intangibles-Goodwill and Other Crypto Assets, subtopic 350-60, Accounting for Disclosures in Crypto Assets, as well as ASU 2023-09, Income taxes, topic 740, improvements to income tax disclosures are also going into effect the 2025 calendar year end. And you can check out our 2025 podcast episodes for more on these two ASUs. So excited to have you here, Mariano, to shed some light on these ASUs.
Yeah, thanks, Carly. I'm also really excited to be here as well.
So let's start with ASU 2023-05, titled Business Combinations Joint Venture Formations, subtopic 805-60, Recognition and Initial Measurements. Mariana, can you give us a little background information on this ASU and why FASB is issuing this update?
Yeah, of course, Carolina. So before ASU 2023-05, US GAAP lacked specific guidance around this topic, causing inconsistent practices out there. So some joint ventures, or what we call JVs, use the carryover basis while others use fair value. The new guidance addresses this diversity in practice by establishing requirements for the recognition and initial measurement of a JV net assets and liabilities on the formation date.
So now entities will have a uniform approach.
That is correct. Yeah, upon formation, a JV must apply a fresh basis of accounting, measuring all identifiable assets and liabilities at fair value on the formation date. This is regardless of whether a business or just individual assets are contributed.
And who's affected by the amendments in this update?
Yeah, entities involved in acquisition transactions affected primarily by exchanging equity interest when the legal acquiree is a variable interest entity, which is known as VIE.
And what are the key provisions we should all know?
Yeah, definitely. It's different from a business combination. The formation of a JV does not result in the identification of an accounting acquirer or a determination that one party gain over another party. As a result, the new ASU requires a newly formed JV to apply a new basis of accounting to all of its contributed net assets, which results in the JV initially measuring its contributed net assets under ASC 805-20, which is business combination, with certain obvious exceptions. And I'm not going to cover all of them, some of them to be highlighted. The first one is obviously initial measurement, the key differences between business combination and JV. So if we think about initial measurement from a business combination perspective, assets and liabilities are measured at acquisition date for value. In the case of asset acquisitions, assets acquired are measured under a cost accumulation model with cost allocated to acquire assets on a relative fair value basis. In the case of a JV formation, assets and liabilities are measured at formation date for date fair value. In the case, another one that I wanted to cover is goodwill. And if we recall, goodwill in a business combination is recognized when the consideration paid is greater than the fair value of the net identifiable assets acquired. If it's an asset acquisition, obviously there's no goodwill to be recognized. And in the case of a JV formation, the goodwill is recognized when the total fair value of the JV exceeds the amount of net intangible assets recognized at formation. Goodwill is recognized regardless of whether the asset contributed represents a business or an asset group. So an important point to make is that many aspects of the new guidance are comparable to acquisition accounting. However, the new guidance does not refer to the joint venture or any of the ventures as the acquirer or the contributed net assets as the acquiree, because the FASB did not want to imply that this new guidance would affect the application of acquisition accounting.
Okay, got it. And can you remind us of who is affected by the amendments in this update and when it goes into effect?
Sure. The new guidance is effective for both public and private JV entities with a formation date that's on or after January 1st, 2025. Entities should apply the new guidance on a prospective basis to all JVs formed on or after the effective date. Obviously, early adoption is permitted. For JVs that were formed before the effective date, companies can choose to apply the new guidance retrospectively if they have enough information to do so. This means going back to the original formation date of the JV, using the fair value of those assets and liabilities contributed at that time, and then updating all subsequent events or periods, which may mean amortization, depreciation, and if needed, any impairment that needs to be taken.
Great, thank you, Mariana. Right, next up is ASU 2024-01, titled Compensation Stock Compensation, Topic 718, Scope Application of Profits, Interest, and Similar Award.
Sure. In March 2024, FASB has issued the ASU 2024-01, which is the one that you just referred, which scope application of profit, interest, and similar awards, which adds illustrative example 10, which goes from case A to case D to ASU 718-10-55 to help determine whether certain awards in pass-through entities are in scope for stock-based compensation.
All right, that's great to know. And why did FASB issue this update?
Yeah, similar to the other one, because there was a significant diversity in practice in how entities treated profit interest awards. Some treated as stock-based compensation under 718 and others as cash-based under ASC 710. So the FASB, in response to this inconsistency, ended up adding an illustrative example to clarify the scope of 718-10-15-3.
Oh, great. And what are the main provisions here?
Yeah, the illustrative example is intended to reduce, as I said, the complexity in determining what a profit interest award is subject to, the guidance in 718, and then existing diversity in practice.
And when does this ASU go into effect?
For public business entities, this guidance takes effect for annual periods starting after December 15, 2024, obviously including interim periods within those years. And for all other entities, they have one more year, so it becomes effective on periods beginning after December 15, 2025. However, early adoption is allowed for both interim and annual financial statements. And companies can apply the amendments either retrospectively to all periods presented or prospectively to profits, interest, and similar awards that are granted or modified on or after the adoption date.
Oh, great. Thank you. Now, last but not least, ASU 2025-02 titled Liabilities 405 Amendments to SEC Paragraphs pursuant to SEC Staff Accounting Bulletin number 122.
Yeah, so this targeted update to ASU 2025-02 is revising ASC 405, as you said, to incorporate the SEC's sub 122 topic, which rescinded prior guidance on safeguarding crypto assets under FASB 5.FF.
All right. And what are the core changes we can share here with our listeners?
Yeah, absolutely. So ASC 405-10-S99-1 has been updated by removing the sub 5FF guidance related to crypto custody obligation as sub 122 rescinded it, as I just mentioned.
Interesting. Okay, so and what's the significance of this?
Well, for one, it brings US GAAP into alignment with current SEC staff positions around this safeguarding cryptocurrency obligations. And secondly, it provides clarity for reporting entities on crypto custody liabilities.
Great insight, Mariano. Thank you so much.
Absolutely. So this ASUs each fill critical gaps in the gap, as I mentioned before, and it's promoting consistency, providing more clarity, and obviously compliance. So
Great. Thank you, Mariano. Well, that concludes all my questions for now. Thank you so much for taking the time to speak with me about this topic today. To everyone listening, make sure to keep tuning in to Everybody Counts for more information on these ASUs and more. Remember, you can find this information and more on our websites under resources. You can also find more information on FASB.com. We're going to switch gears now and play a little game we like to play on the podcast called This or That. So I'm going to ask you a question and you'll choose which you prefer.
sure, thanks, Carolina, for having me. And yeah, I'm ready to play this game.
Great. All right. So candy or chocolates?
Chocolate.
Beach vacation or ski vacation?
That's a tough one, but I will probably pick beach vacation.
Coffee or tea?
Well, I don't know if I'm allowed it on this one, but I'll tweak it a little bit and I'll say mate. I'll pick mate, which is closer to tea. But yeah,
Oh,
that's my
great.
pick.
Mate. I'll have to try that one day.
Yep.
Thanks again for the helpful information today. I'm very appreciative of taking time out of your super busy schedule to chat with me, Mariano. A great time speaking with you. And to everyone listening, we appreciate you listening in and invite you to check out our website, www.malonebailey.com, for more information about public company audit services, as well as some other useful resources. Thanks again for listening.